Good afternoon, everyone, and welcome to Stock Market Today. It's Alissa Coram and Mike Webster with a breakdown of the action, not only in today's session, but really a look at how the week unfolded. Mike, it's great to see you.
It was a mild, kind of tame week, right?
Super tame. Nothing really happened. Very tight spreads every single trading day. Anyway, we have a lot to unpack. There's lots of questions. I'm already seeing our chat flooded on YouTube with questions for us about the follow through day status and where we're at. So we are going to really fill everyone in on where we're at with this rally attempt as the market tries to find its footing after a brutal couple of sessions that we're trying to still digest and work through. So really looking forward to getting your thoughts on that, Webby. In terms of the layout of the show, we will give our high-level market thoughts. We'll go over sector ETFs, signals that we're seeing there, and 3 tickers to watch. Then in the second half of our program, we are going to dig deeper into the charts, take a look at some of Webby's indicators to give us that additional perspective of where we're at. Then we've got some homework for everyone, so get excited, and maybe we'll answer a question or two from the audience along the way. So, you ready?
I'm excited. This sounds like a good show. I want to tune in.
All right. Well, here we are. Let's get started. First, with a look at the major indexes. So today, the NASDAQ up 0.5%, same for the S&P 500. The Dow today up 0.1%, and the Russell 2000 down about 0.3% by the close. We are mostly focused right now on the index level on the NASDAQ and the S&P 500. So here's a look at the NASDAQ, that tech-heavy index. So Monday, what a wild day. What a crazy open, huge gap down, found footing at the 200-day line. We are making progress from there, but we don't yet have our signal that we love waiting for more proof that institutions really are going to step in and support this market. But we are seeing some positive steps in the right direction.
Yes, we are. So there's so much that went on, and let's just kind of recap. So last Wednesday, not this Wednesday, but last Wednesday, we had Powell. He hinted that he was going to do a quarter point in September and then 2 more later in the year, reading between the lines. So that sparked a rally on the S&P that qualified as a follow-through day. The following day, we had what call it a negative expectation breaker, which means you throw out that follow-through day and you get very defensive as quickly as you can. And that's what you would have done. And then the next day we had that gap down. But over the weekend is really the news about, the whole, what was going on with Japan and the yen carry trade unwinding, and the global markets were just kind of in a meltdown. And frankly, on Monday, we could have really had a crash, like a 1987 crash that was in the cards. Now, luckily, we had raised a bunch of cash already going into that. So like, for example, like swing trader, we were only 5% in, going in, into the weekend. But still, that wouldn't be good for the economy, wouldn't be the global economy, wouldn't be good for the market if you crashed. And let's go back to the NASDAQ, because I think what happened there is, and we're going to talk about this later, is that 200-day. The 200-day is a serious guardrail. I know our good buddy Jim Ropel likes to refer to the 50-day as a guardrail for individual stocks. He's dead right about that. For the indices, the 200-day is a big deal. And so that's that black line there, 40-week if you're looking at it on a weekly chart. And you can see that's where the big funds will step in and really support the market around that level. If you've done any level of back testing, from just a little bit of back testing to heavy, multi-year back testing, or spending multiple years doing back testing, you'll quickly realize that the 200-day, 40-week, same thing, is the most powerful thing out there. It really, it's kind of like night and day. You're above the 200-day, you're in a bullish phase. You're below the 200-day, you're in a bearish phase. So everyone knows that. The algos know that. Big discretionary funds know that. So they either support it there or they don't. And you don't know if they're going to support it. So far it's been supported as NASDAQ came down there. Now let's toggle over to SPY for a sec. And that one is further away from your 200-day. So I think it's, even though we're looking for a follow through, hoping for a follow through, I would say that typically when you go down and test an area, there's a retest. And a retest would really, coming all the way down to that black line, which is right around the 500 level or 5,000 on S&P 500, 500 on SPY, that would be normal and logical. And if I were a bear, I would push the market down there on any negative news, hoping to break it. Because you always want to think, what are the bears thinking? If I was a bear, I would look at this and say, okay, we wedged up this week, meaning, we came down hard, got some support, had an oversold bounce that feels wedgy and is vulnerable, right? Because a wedge underneath a 50-day, especially a flattening or declining 50-day, is a weak position. So if you're short, if you're a bear and you're looking to short, you're getting ready. Like you're, ready to put some shorts out there, especially if we were to get a gap up fade. That's, kind of like what we had 2 days ago. That's something, if we got that at a higher level, that would be an ideal place to short. So the reason why I say all this is you've got to know what both sides are doing. And at this point, you're probably very light in the market or out of the market, and you're sitting waiting for your signal. And that is the power of waiting for a follow through day, is that you don't have to play. You can play if you want. Bill O'Neill, the founder of IBD, before there was a follow through day, he would nibble, he would take some test pilot, buys and see if they were sticking or not, and then back away if they weren't. And there's nothing wrong with doing that as long as you're flexible. So that's where we're at right now. We had our gap down support on Monday, where we really could have crashed, and then we've bounced up. And it hasn't been, when you look at the daily, it doesn't look that impressive. Let's toggle over to the weekly for a sec. And let's go. Yeah, the NASDAQ is, a little bit more impressive there. It looks like some serious support around the 16,000 psychological level, as well as that 200-day. So they were more than the SPY. They were kind of putting a line in the sand, saying, I'm going to defend this. We will see how that plays out. So what do you do with this? Let's go back to the daily. And so Monday was not day one. It was not a pink rally day. So for a pink rally day, that is a rally day that closes down on the day. You need to close in the upper half of the true range. That means if you have a gap like you have there, you take the close the day before. So in this case, the Friday close the day before, and you take the low of that day, and you want to close in the upper half of that. That is the lowest possible level for a pink rally day. Now, when we were studying this, Charles Harris, Justin, and I, for the market school, and coming and quantifying these rules, rather than just having a feel the way we used to do it, Bill really wanted it to be in the top quartile, 75% closing range or higher is what he wanted. But we settled on the 50% to be just more inclusive, to make sure we didn't miss out on any rallies.
If it was a down day, right? That's what we're talking about. That first day, where do you start day one of the rally attempt? If it's a down day, is it in that 50% true range? And you're saying Bill wanted 75% closing range.
And honestly, I wanted 75% as well. All of us did. But we also were looking at everything and saying we wanted to err on the side of making sure we didn't miss anything. And so lowering it down to 50% was as low as we could go. And so I know a lot of people are out there, thinking it was a pink rally day. It doesn't matter at this point because we're far enough out, but just so everyone knows for next time, it's the true range, the top half closing there. That would be if it was a pink rally day. So that wasn't. So now we go to Tuesday. Tuesday was an up day. So therefore, that's your rally day or your day one. That becomes important because a follow-through day can't happen on day 2 or day 3. It has to happen on day 4 or after if it's going to happen. It could be, everyone thinks 4 to 10 days for a follow through day, but they don't always happen in that window. Most of them do, but sometimes they're the 14th day or the 15th day or the 25th day. So they can take a while before you get a follow through day. So now today was day 4. So today we could have had a follow through. We didn't, but we're looking for it. Any day that we have going forward that's up 1% or more and the volume is higher than the prior day, then that becomes a follow through day. Now, as long as we hold above Monday's low, not Tuesday's low, but Monday's low. So Monday's low has to hold. If we undercut that, then we start this process all over again, looking for day 1 and then waiting for day 4 or after. And this day 4 concept or after really came from Bill realizing that lots of times when you're in an intermediate correction that could lead to a bear market, you get these little bounces along the way that, lots of people call them a dead cat bounce or an oversold bounce or mean reversion. You call it whatever you want, but it's just a weak rally up. That's what we've had so far for the most part. And you don't know until you get that extra thrust. So there's like a time thing that you want to have your original rally, a pause, and then a bigger move. We did have some constructive action yesterday. It was an inside day, inside of the prior day's high and low. So that was good, closing near the highs. So that was a sign of some, accumulation there. And today is what I've always coined a setup day. And they don't always work, but it's set up to move higher. That's why I call it a setup day. And how you define that is loosely is a very tight spread closing typically in the upper half, the higher the better. And so what is that doing? You've got a tight spread. That's an equilibrium level, meaning you're not traveling a lot from your high and your low. So the buyers and the sellers, the bulls and the bears are more in an equal place, and they're trying to decide which way are they going to go. And so next week we've got PPI, we've got CPI. Those are market moving reports, especially the CPI. And we could get a sell off on that. We could get a rip. We don't know. Nobody knows. But we're at least in position now. And I believe the CPI is on Wednesday. So we're in position to have a follow through day. But also because we've wedged up, we've just kind of, drifted up this week, that we could certainly come down and test. So you have to keep an open mind to anything, but you need to know you are in position for a follow through day. So even though everything seems negative and it feels negative, it always does before a follow through day. You want to do a bunch of research this weekend, look and see what groups are holding up, what stocks are in position. And we're going to share a screen at the end of the show to help you with that.
Right. And also just to reiterate, not all follow through days work. So it's a signal of a potential change in trend that could have some legs, but that doesn't mean, all right, now I'm going to go from 0 to 100 or, really start loading up. You want to see the setups and take a measured approach, right?
Yeah, and that's something that Bill would always say is you start off with a few positions, you see if they're gaining traction, and then you add to it. Now, aggressive traders are going to go more aggressive and conservative traders can go more conservative. Do what you feel comfortable with. But he would always say on a follow through day, you have to buy something. And we always did. He always bought something. I always bought something because you want to change your mindset. Because whenever you're in a position to need a follow through, the news is negative. You have unknowns. We don't know who's going to win the election, who's going to win Congress. You don't know what the Fed is going to do. You don't know how this Japan thing is going to play out. All of these unknowns. There's always unknowns, right?
Yep.
So you need to be optimistic, but realistic, because like you said, a lot of them fail. In fact, most of them fail. The majority of follow-throughs fail, but it gives you a point of reference to trade from. So let's just say today was a follow-through day. It wasn't up enough. But if it was, then today's low would be very important. You would not want to close below that. If you close below the low of the follow-through day, it's going to fail. Sometimes it takes a little bit of time before it totally fails, but almost always fails. Just like if we go back to the S&P and look at last Wednesday's follow through day, once it closed below the low of that day, what happened? It fell apart. That tends to be what ends up happening because people recognize, hey, this rally isn't holding, and they start selling. The bears, see that panic, and then they push on it, and then you get moves like we had this week. So that's a long way of saying we're in a position waiting for a follow through day. If you're heavy in the market, I would really, if you're still heavy, I would really look at all your holdings and make sure you have stops in there. In some cases, if you got something with a really low cost basis, that you've had for a long time, maybe that's fine to hold on to. But if it's anything relatively new, if you're down on it, I would just kick it out, frankly, because we could easily test the 5,000 level
Right.
on SPY.
Exactly. I mean, there probably are some traders out there who are saying Monday at the open, that was the time, that was the opportunity, the whole blood in the streets thing. And who knows, maybe that is our bottom. But like you said, if we get a retest, and the reason why the follow through day has that time element is because when you get a sharp break, that there's a pickup in volatility. So even if you do get, that, first or second really strong up day, you haven't bottomed yet. You're just getting that pickup in volatility and things can further deteriorate. So is this the bottom? Is it not? We don't know yet. So we'll just take things day by day.
Yep. Well said.
Okay. Next on the list, do we want to take a look at some sector ETFs?
Sure.
Okay. So let's do that to give some added perspective to what we're seeing. So I just have this sorted by what was up the most today on this setup day. We can just go through, and as we've been doing every Friday, we've been most focused on the relative strength line here. So we will do that. Here's XLC, the communication services. Meta is in here. The price action here looks a lot like Meta stock, but if you look at the RS line, you can see that that's been holding up pretty well, I would say.
Yeah, so that's the pond that you want to look at to fish in. You can pull up Meta since it's
Sure.
just real quick. Arusha, our good friend, great guy, was on IBD Live this morning, and he was talking about this one. And there are a lot of reasons why you'd want to look at one of the leading mega caps that is holding up like that, because if this one is kind of the canary in the coal mine type of thing, if this one works, then maybe some of the other ones will work as well. Do we like that setup, that chart? No, it's a breakout failure, sloppy recovery. I mean, it looks terrible, but it's in the context of the overall market. And that's why Bill, kept those RS lines on there, because it would, that makes up for the fact that it's terrible action for the last month. It's all over the place. There's no real rhyme or reason. It's up a lot. It's down a lot. It's down a lot. It's up a little. But that RS line is telling you that's where the money is flowing. So I would look at the rest of this sector, even though it's basically Google and Meta that make up the bulk of that.
Okay, next on the list, XLRE, which has really held up well versus the downdraft over the last 2 weeks.
I'm seeing a lot of these stocks coming through my screens, and I typically don't trade REITs, but this is a time where I probably would. You're going into an interest rate environment where, interest rates are going to be coming down. We just don't know how quickly, but that helps out the real estate area, obviously. So this is, with that RS line, this is an area to look at. I would do a lot of screening with REITs.
Right. But this also screams defensive, right? Like if this is the area that is seeing a relative strength line that's surging, shows you, in addition to utilities, which we'll look at, but just shows you that defensive mindset. Healthcare too has that defensive growth type of vibe to it, depending on the stocks that you're looking at in this group, but healthy RS here too.
Yeah, and on top of that, you want to look and see how did these things react on Monday, because that's your tell, right? Where any stock you're trading, any ETF you're looking at, look back to how they broke on Monday, and you know if you have strong holders or weak holders in there. And this one held up pretty well, relative to some of the other things that, just fell apart on Monday. So that's a positive sign as well. So this is an area where in a bigger pond to fish in too, right? Because there's lots of healthcare, medical related stocks out there.
Exactly. Here's a look at XLK. This is technology. So even with a gain of 0.5% on Friday, I guess would make it the third or fourth best performing sector on the day. But if you take that step back, still very damaged and hanging on right around that 200-day line. Not a whole lot of lift in the RS as of late.
Yep, I agree.
And here's our bogey. There's SPY, just so we can get that in our minds as we go through this. And here's XLU, the utilities, which we mentioned.
Yeah, we were looking at this. I was talking with the guys, with Dominic and Justin today, and we were toying away around with putting this on. But like you were saying, this is a defensive place, right? So this is more likely to work if the market rolls. So it's just. I think it looks set up. You've got the nice upside reversal. I would see nothing wrong with buying this here, or a lot of them in this group. Pull up NEE. That was one that I was looking at. I don't have a position in it, but even though it's not showing up as a cup with handle, it is a cup with handle. And that downtrend line there, if it goes above that, that's something that I would consider buying. Now, if we get a follow through day, then I probably wouldn't buy it, because when you have a follow through day, you tend to go into risk assets, whereas this is a place to hide.
Right. Good point. Okay. And here's XLY. This is consumer discretionary.
Yeah, that looks just terrible. So I would avoid that.
Mm-hmm. XLE energy.
Same thing there. It just doesn't look good.
There's RSP, the equal weight. We are back above the 50-day line there for that one. Here's XLP, your staples, also very defensive, trading very tight.
Yeah, and look at Monday. Like, it didn't even break its 50-day. So that's a reason, to play in that space, like the utilities, that if we're going to roll, that this is the place that you would hide. Now, as individual investors who don't have the mandate to stay fully invested, you could just stay in cash. You don't have to do the utilities or the staples, but big mutual funds have to stay fully invested. So, they would likely rotate into both of those spaces, as well as the REITs that we were looking at.
Mm-hmm. Here's XLI, the industrial sector.
Even though it wasn't up that much today, I would still look at. I'm focusing my eyes again on that RS line versus its moving averages. It's still in a nice uptrend above those, so I think that you can look in that space.
Okay, XLB. Here's the materials.
Not so much there. So it was a breakout failure, and then that RS line is going back through both of its moving averages. So I would avoid that.
And that's it. So now we want to take a look at a few other ETFs before we move on. Some thematic, a little bit more focused. Those were the broader sectors. Now we're getting a little bit more focused. Here's a look at the KIE ETF. This is insurance.
Yeah. So this is a pond that I'm looking to fish in, because it has wedged up over over this week, but it did get nice support at the 50-day, and it's slower and pokier, right? So if we could be in for like a 3 waves down type of move, like we had last year. Pull up the NASDAQ for a second, real quick. And and you see those 3, if you could point to the 3 waves down, we could be in for something like that, months of going sideways and grinding lower. You have to be open for that as a real possibility until we get clarity on the Fed and some other things. So with that said, if you want to play something like the KIE, is a place where you can likely not get that hurt. And a way of knowing how bad you would get hurt, is you just look at late last week to Monday, and how much did that come down? It wasn't down that much, not relative to like the QQQ.
Right, exactly. And a lot of tight areas that you can see going back. So yeah, the volatility there not as much of an issue as some other areas, perhaps. Here's ITA. This is aerospace and defense. Very similar look to it lately.
Yeah, similar, a little bit stronger. Just the position of it, and it did get nice support on Monday, like a lot of things did, and is back above its original pivot. So this is a space that, what was it? Was it HWM?
Yeah, HWM
Yeah.
one. Mm-hmm.
So for people who are looking to buy, what I would suggest in this market is that upside reversal you had near the 21-day. That's the type of area, that's the ideal setup. So it broke out of something, pulled back in, found support on top of the base, not underneath it, like a lot of these other things, came all the way into the base. That's a sign of strength. So that's the setup that you're looking for, because you have a nice exit. The exit was the low of that day. It corresponded with the 21-day and your original pivot. So you've got all that going for you, and then this lifted nicely. It's not in position to buy now,
Right.
But just going forward, when we have weakness, that's the type of setup that I would say you'd want to buy.
And we quickly want to take a look at the chips. Here's SMH.
Yeah, it's nice that it's back above its 200-day after dipping below it, but this one just feels like it needs more time. Obviously this is the leading space. If this bull market is going to last a few years or longer, and the whole AI theme and everything, might as well pull up NVIDIA, since that's what everyone cares about. It's base building at this point. Let's go to the weekly on that. And this is the left side of a base. And what you want to do is go back and study models and see, what's normal. When you come down like this, shooting straight up to 140 in a week or two would be abnormal, and probably, something you'd want to sell into. So what would be normal is you come down this hard, you've stopped generally on top of the last base for the most part, got some support there, that rounding out, it's a matter of time, the time element. That was a, Jesse Livermore thing. So yeah, a month or two of grinding sideways to rounding out would be normal. Now, of course, there's, stocks top, they top when you don't think, and there's always a possibility that this one topped. But I would say I don't have a position, so I'm just being objective. It's just, there's some good action in there. This week, nice supporting. I would say, it probably rounds out, but you've got time on your side.
Exactly. What we don't want to see is the second scenario that I drew in, which is if you get a wedging week rally and then a rejection at a declining 50-day or a 10-week line, that would not be as ideal. I mean, it still could be forming a base in that instance, but just like that's what we're looking for the indexes, also just going to be on watch for that.
Well, yeah, the way you drew that is certainly a possibility of having a double bottom. Like if people study bigger double bottoms, like going up, running out of gas, and then coming down, and then you undercut the first low, that's normal and natural for a double bottom and a bigger one. That's certainly in the cards, because think of it, if you were able to withstand this, what are you thinking right now? You're thinking, oh, geez, thank God it bounced, it's off the lows. I'm going to put my stop in at this week's low. That's logical. So the shorts know that, they push it down there, try to break it. And then if the bulls step in, that's where you get your double bottom. The bottom line is, if you're not in it, just grab some popcorn and just sit and wait and watch and see how it plays out. There's no need to jump into it.
Yeah, for sure. And we've got earnings coming up in a little less than 3 weeks. So that, of course, is another thing to keep in mind here. So we definitely will have the popcorn there. Okay, and then just really quickly, because we looked at SMH, finding support at the 200-day line. Here's IGV, the software ETF, broke support below that 200-day line, but was able to manage getting back above that key long-term level by the end of the week.
Yeah, so this is an area that, because it was able to bounce back so quickly, and let's go back to the weekly, because it does paint a pretty good picture of that nice upside reversal on there. And, that looks like the bottom of a base, kind of, like that would be normal. So, ServiceNow was looking interesting. I would say in this space, before I really liked CrowdStrike, but they really blew it. They're in the penalty box for a long time
Right.
now, but ServiceNow looks good. And I would say if I was going to play this space, I would either do ServiceNow or IGV, but neither have to be bought.
Yeah.
I would go to something a little slower and pokier because you can see with those spreads in there, the likelihood of, certainly wouldn't swing trade it because it needs to tighten up before that. Otherwise, you're just going to get chopped up.
Right. Well, speaking of, I think that's a great segue to take a look at Costco. This is not something that has big, wild swings. And we saw Costco on Friday getting back above its 50-day line with a gain of about 1.9%, rounding up there a little bit. And what I like to see was that relative strength line getting back to new all-time high ground before a breakout. So if there are folks out there who like getting into stocks on 50-day retakes like I do, this is what you want to see as something with potential.
I totally agree. And we put this on Swing Trader today because we didn't have any exposure, which was fine, but we're in a position where we could be getting a follow through day. So we wanted to have a couple tests out there. So we did a 5% in 2 stocks. So we're 10% in, just testing the waters. And this is one that we did. And then once our time restriction was up, our compliance thing, I bought some as well.
Yes, same here, which I should have mentioned as well. It's so funny how quickly, when you go to cash, you get out of the habit of saying, oh, I own this, because I've been in cash for a little while here, but starting to dip my toe back in the water too.
Yeah, and you just want to dip your toes. You don't want to dip your foot because you get it chopped off. You can still walk without a couple toes. So, with this, you're nibbling and saying, okay, what would be normal? You just want to picture in your mind what would be normal. Normal would be moving up close to 900, backing off and maybe forming a shelf or a handle or something, and then moving higher. This is a company that you can understand. Let's go to the monthly chart on it. This is a monster over time. It doesn't really fall apart because, it's somewhat recession proof. As recessions come, people do more shopping there. It's all about the membership fee, not so much on what they sell. And so it's got a great business model. If I ever move, frankly, the first thing I'm doing is seeing where the local Costco's are. And I will only move within, like 30 minutes of a Costco. Do you shop at Costco?
Yeah.
Okay. So
I do. Although I'm kind of like Arusha, I'm not going there as often as I could. It's like, you got to gear up for a big trip in my view. If you're, you don't just stop in there for 2 things.
You can,
kind of the
but
point.
It's dangerous.
Right.
It's very dangerous.
But then you got to wait. It's very dangerous.
The key, I will give you the key. If you're going into Costco, don't bring a cart, and then then you'll be able to get out alive. And it'll be your you don't have to go to the gym that day. So anyways, we like the story. We like the what they do. They do a great job with everything, and you never know. We always talk about AI. I imagine they're spending a bunch of money on AI trying to figure out how it could help with them with inventory or whatever. I don't know. So let's go back to the daily and just kind of talk about that for a sec. So the entry point, it was recovering back through its 50-day. So now you have a good stop. You can either use today's low or really yesterday's low with this one and try to give it a little bit of space. And like you had pointed out, that RS line is just solid and it's telling you this is where money is flowing into because it's safety money, So it looks good to me.
Yeah. Okay. Similar action, but not as, tame of a stock, I guess you could say. Something a little bit more high octane, or maybe you could tell us about the ATR for these stocks. I would imagine a little higher on something like a Cava, which also got above its 50-day line today. This one with a little bit more oomph behind it, up 7.5% by the close. I also did decide to add a position here in Cava today. I really do like the 50-day retakes. So this was right down Allie's alley
Okay.
today.
Well played. So we put this on Swing Trader as well, and I did buy it once our
Yep.
30-minute window was up, and we put it on as it was going back through the 50-day and recovering through there. And you can see that that high to the left of it right there that it was able to surpass as well. You had a really nice support on Monday. So that was a tell that this one, it's kind of a high octane name. It's a newer name. They could have really thrown in the towel on this one. And this could have been at $60, easily. But they stepped up and supported it. So that's what you always want to do on those big days in the market, up or down, is seeing what is moving, what's getting support. I like that action, but I just don't like buying things underneath the 50-day unless it's a shakeout +3, which is relatively rare. So that went back above that high that you marked, as well as the 50-day. So we're giving it a shot. You asked about the ATRs. So Costco, the ATR, the average true range, how much it travels on a regular basis over the last 21 days is just shy of 2%, so 1.93. So that's good, right? Cava, not so good. 5.25, 5.26. So that tells you that you're more likely to get shaken out of this with just normal movements, because it normally travels from high to low 5.25%. So if you're like me, who likes to put their stops at 3 or 4%, it's easy to get stopped out. So we're using today's low as our stop for this one, both personally as well as for Swing Trader. So we'll see. Again, like the Costco, you want to picture what would be normal. What would be normal would be a run up near the 100 mark, and then probably back off, if it works out, back off before earnings, and then earnings are a total crapshoot. And so I might try them again. I just don't like their food. My better half loves it, and so typically I'll drop her off there and I'll go somewhere else. But I might try it again this week.
Yeah, you need to try it again. Give it
Do you
another
like
shot.
it?
Yeah. Yeah.
Okay.
Yeah.
Cool.
I thought it was good. Yeah. You should try it.
I will try.
See, I'm sure, and also your better half, I'm sure she can, have good recommendations for you on the menu of knowing you.
She loves the pita, and since I'm gluten free, I can't do the pita, and a few of the other things, since I'm essentially vegan, gluten free.
I'm sure she could give you her recommendations for what fits your dietary restrictions and what she knows is good.
There you go.
Yeah.
Do we have another stock?
We do. We'll move on and go to ONON, because if we're getting our watch list prepared for a potential follow through day, here's something that is forming a base with earnings due next week.
Yeah. So this, the average true range on this one is a little bit less than the Cava. It's 4.29. And I'm looking at this, even though my pattern rec isn't picking it up, it is, I'm looking at this as a double bottom. So you have the 44.30 is your left side high. Perfect. This week we undercut the 36.05, which is what you want with a double bottom. You want to see that undercut. So the 42.45 is a good entry point on this one. But again, like you mentioned, we've got earnings this week. So it's either gonna, it's either gonna gap up or gap down. Let's pull up Bros for a second, because this is one that I really liked. And it's a reminder that earnings are crapshoots. You go into it, great concepts, always busy. I think this is the next in and out, blah, blah, blah. But on earnings, you can get these bad breaks like that. And so this one is now in the penalty. But when you get a break like that on earnings, you put it in the penalty box for several quarters. So I would put this in the penalty box for 2, 3, 4 quarters. So who knows how ONON is going to play out. People seem to love their shoes. I don't like the gravel that gets stuck in mine and the squeaks, but it is what it is. The chart is setting up.
All right. Well, now let's pivot to a weekly view where we're going to take a look at some candlesticks to see where we're at from that step back look. So over to those charts, which we've got pulled up now.
All right, so we're looking at SPY on the weekly. We're taking a step back, the old Grateful Dead thing that they would do to make sure that the audience wouldn't get crushed. And I can't let today go without saying, thank you to Jerry Garcia for everything that he gave to us musically and more. Of course, he passed away this day back in 1995. So, anyways, with that said, for the three deadheads who watch, so this was our prior move up from those three waves down from November up until April. Then we had our correction. It fell out of that really nice channel that it had with these regressions. Then it came down naturally and normally, and then it had another one even tighter trading range within this regression on a weekly, and we fell out of bed here. Now, what's great about candles is seeing the power there. That this blue candle obviously opened up down here and you closed here, doesn't get better than that. And you can look back at other bottoms, like over here, this big, huge candle back in the week of November 3rd, and you have other ones historically as well. So it's really good to study candles on weeklies and monthlies, because that will, the colors, of course, the pink means you open higher than you close, very negative thing. But the changing in directions you can see a little bit easier on candles, in my opinion. And we have the same thing here on NASDAQ. And with this move up, you can see this was nice and orderly, but this one was going at an angle that you just could not sustain. So that's it for the weeklies. We can toggle over unless you have any questions on that.
No, that's great. Let's take a look at the regression lines a little bit closer.
Okay. So here is our old regression that we were doing from April 22nd, and we were going out 50 days with that to July 2nd, and it fell out from there on July 24th. And even with this follow-through day that we had on the 31st of July, obviously that failed with our expectation breaker on the 1st of August on Jerry Garcia's birthday. And then you had this gap down that we had. So at this point, looking at on the candles, you can really kind of see that wedgie type of feel that you want the uptrends to be tested a little bit more than what we've had. But we'll just see what we can get. The good thing is this week we have 4 blue candles, meaning you closed stronger than you opened, and just that one really bad one in the middle of the week there on the 7th, where you opened up, traveled higher, and then closed at your lows. But you got the nice little gap the next day. So not a whole lot to say there. We're obviously waiting for a new trend to start in similar type of action on the composite.
Now let's take a look at some 50% retracements that you have on SPY and the NASDAQ for different time frames. So I think very interesting.
Cool. So we will start with the smallest, and then we'll go out to the longer 50% retracements. Again, the 50% retracement is a big part of what I do. Refresher that any move up, it's easier to think of it in moves up. When you break out and you move up, let's say you break out of a stock at $100, goes up to $120, giving half that back, going down to 110 is normal and natural. Anything more than that is weak. Anything less than that is strong. So the 50% retracement, we can do it on an intraday basis. We can do it on a monthly basis, everything in between. Big part of my process to tell me where we're at. So we're going to start off with looking at last Friday's close, because the news really hit over the weekend that drove the market down. Last Friday's close down to Monday's low, which was near the open, and then doing a midpoint or a 50% retracement from there, and that's 521.59. So from that very short-term level, we were wanting it to live above that midpoint as our first little hurdle to get over, and we were able to do that there with SPY. We were also able to do it with NASDAQ using those same things last Friday to last Monday. Now let's step back a little bit more, and we're going to look at this from last Thursday, the high of the expectation breaker, right, Monday's low, and look at that midpoint or that 50% retracement. And so that is 532.57, which we were just able to trade up to that area today on SPY, which is good. You don't want to just get up to it. You want to get up to it and actually trade and live above that area. So for this to be healthy, we want it to be up in this area, closer to 540, really staying above the 532 and a half and trading up to the 540 would be ideal.
And what's at 540? What else is at 540?
Oh,
like
you're paying attention. And what is that? I don't know.
It's like a key moving average to me.
It does look like that 21-day exponential. Yes, good eyes. You see everything. It's not fun doing these shows with you because I feel like I'm not needed.
What?
I don't need.
Are you kidding? This is so fun.
I could go to sleep. Okay, so here's the Nasdaq, and same time frame. We got just up to that. Now, these levels. This is 16,750 is the midpoint there. They were pretty much got right to. The level itself is not as important. It's living above that. So unlike a 50-day moving average or the 21-day moving average where everyone is seeing it and it's obvious, it's on everyone's screens, most people aren't doing 50% retracements, and it's an art. So you're picking different points. So that's why I say it's not important, that key level, it's the feel. Is it living above it? And so with this one, you really want it to be closer to 17,000. And again, that is close to the 21-day that you had pointed out at 17,159. So we're going to look at one more of these, a bigger version. And this is going to our recent highs on July 11th, down to Monday's low, and looking at that 50% retracement. And where is that colliding with?
Yeah, exactly. That is right at the 21-day line here on the comp.
Exactly. So you could imagine us going up to that, running into resistance, and then coming back down. So this is a level that the people that use the 50% retracements are more likely to use this one, not the other two that we just went over, because it's more cookie cutter. The recent highs are recent low. If you were going to program something into a computer, doing a mean reversion thing or anything like that, this is how it would calculate. So that's right at the 21 days. So that is really going to be important. But again, we want to be above that. And same thing for SPY. That's at 537.72 and coincides right with that 21 days. So that's a big deal. That's a big area. Yeah.
Absolutely. Totally agree. That's critical. Okay. Now let's take a look at our levels.
Okay.
Which I sort of jinxed us a couple weeks back. I think I said something like, oh, we always have all these extra levels on the downside. We never want to go down there. But this is why we do that. We put in that prep because to get prepared for these different scenarios, right? So we did come down to some levels.
Some levels we did not want to revisit, right?
Exactly.
But we did. So I put several in here, and I could have put more, but I'm trying to keep it less busy. So let's blow this up and just kind of look. So I like to, and this is what you should do, in my opinion, on your individual stocks, on the averages. Put as many as you're comfortable with. If you're comfortable with only 2 or 3, put 2 or 3. If you can deal with 10 or 15, put 10 or 15, because they're all important, but you don't want it to be too busy that you can't make sense of it. So I always have one of the all-time highs, but I also put it at levels where it ran into resistance. So I'm using the expectation breakers high, which is August 1st. Also looking at some areas back here, like the June 28th high, that coincides with the June 20th high, just levels that are important. But I would say that the August 1st high is really the big deal. Then same thing with the July 25th low. We want to get it back above that, which kind of all these levels kind of end up going to that same place, which is your 21 day, that blue area there. And then we have the level here that we pretty much closed at, that coincides back with the old May 23rd high. So just, color code it, do something that's comfortable. You don't have to mimic exactly what I do. I just want you to understand the concept. Also, this upside reversal that we had on May 31st, which was a big deal that day. That low, getting and staying above that. So we were
Which
able to get.
coincides with the day one low, although it's really the day before that we don't want to undercut for sure.
Exactly. And that's why I made that one a solid line.
Yeah.
That's your line in the sand that we could very easily test. If I had to put money on it, we test it, but my opinion is worthless. As Bill taught us, all opinions are worthless. It's just whatever the market does, but you want to be ready for either. And then of course, this was this old line that I had from way back when, but really if we get down to the 200-day, that is your major line in the sand. We'll do the same thing just briefly on the composite. You can see all this noise here. Same type of levels. Really, your expectation breaker high. I should have moved one there, but it was just getting a little too busy. And just look at the ones that are around us. So right now, what's around us is that May 31st low, which again, kind of coincides with Monday's high, coincidentally. And then our line in the sand is really the low from Monday.
Right. And then next week, if we do get a follow through day, then a new line we would be the low of that follow through day.
If we get a follow through day, that low, remind me, needs to be like super solid, like multicolored. Like it becomes a big deal. But on a closing basis, you can test it intraday, just like last Thursday, the beginning, after that follow through day, we were undercutting it, but you want to be patient with it. That was, in hindsight, wasn't the time to be patient, but you always want to be patient right after a follow through day. On balance, it's going to work itself out. And our final one here is our 21-day, just to keep it clean, keep it simple, the Gene Simmons chart of the week. And that is just with our 21-day right there. And it feels like a ceiling. And let's look at the composite. Same thing here. We will keep an open mind though.
Yeah. I mean, pretty simple correlation. When we're above the 21-day line and that 21-day line is rising, that's a good time to be in the market. When you're below that 21-day line and when that 21-day line has rolled over, that's not as good of a time to be in. So hopefully we can make progress and get back on track.
Yeah, I guess years ago I said, and I'm going to stop sharing that and switch over to my trading view. But years ago, I guess I said something like, bad things tend to happen underneath the 21-day and good things tend to happen above it.
Yeah.
And I don't even remember saying it, but somewhat, I don't know if I borrowed that quote from somebody, but everyone, says that that's what I said. So, with that in mind, that's how I've always traded, back, since the late 90s is, if you're above it or not. I'm having trouble getting to my trading view. Just give me 1 second.
Yeah, while you do that, I'll just give everyone a little preview about what we're going to pull up. We have 2 views that we want to take a look at. We have our Webby RSI, which should be pretty quick to take a look at. And then we have our off high indicator. So
tell me if you can see that or not.
Yes, we've got it. The audience is seeing it now.
Okay, perfect. So the Webby RSI, we'll be quick with this because we go over it every week. Now that our high is underneath the 21-day, that's when you're looking at this kind of the burnt orange color on here. And that is the distance in ATRs that your high is versus your 21-day. And when you get to extreme levels, like we had on Monday, that is when, you tend to have this oversold bounce type of move. And so that's why I have it on this side, just to know, what to expect. Now that is contracted a bit, you can see that the histogram has gotten smaller. And of course, what we want is our low to get above our 21-day. And then we'd start getting some blue lines there. And the blue histograms, of course, are low versus our 21-day expressed in ATRs. And here's the same thing for NASDAQ. So same basic feel. Not a whole lot to read into there. We had, it was oversold and, we've bounced. So we've got to see how that plays out. Any questions on that one?
Nope. No
Okay.
questions. Let's go to the Bob Marley indicator.
Okay. My daughter's favorite indicator, the Bob Marley. And again, the green is within 4 ATRs of your high, yellow is 4 to 8, and red is anything below that. And you can see why I like doing it this way is you can see if the current pullback is unusual or not. And it was, right? Because you can see from our 3 waves down that we had, that we came out of last November and had our nice trend up, we were just staying in that green that whole time until this intermediate correction. But this correction that we've had now is more severe than that. And so you really want it to get back into the green area, but really above this level, which is about 2.75 ATRs from your high. That would be ideal to have a more of a comfort level that we're back on track. And let's just look at NASDAQ. That one got worse. That actually got into the red territory, 8 ATRs off its high, which was just a little bit better than what happened during those 3 waves down, where that one got down to 9 ATRs during the second wave down. So it looks pretty ugly. Again, we wanted to get to 4 ATRs, or really above this level here, which is basically about 3 ATRs, and that puts us back to the July 23rd timeframe. That's all the way up at 18,000. So you're going to be trading before it gets up to that level, but that's when you're really more comfortable with the market.
Yeah. Okay. Let's go back to market surge homework time, Webby.
Homework time. Do you really want to give everyone homework? It's been a hard week.
I know.
Okay. I'm going to give out the homework.
Next week we get a follow through day. Could be a key week. We don't want to just sit on the sidelines and not put the work in and miss a good window if we get it.
Yeah, we're not slackers around here. We're going to put in the work. So this is a project I'm going to be doing myself. Over the weekend, I put it out on Twitter. If you follow me, yesterday or the day before, someone had asked for homework, and so I put this out. And the concept is looking at historically. So go back on NASDAQ as far back as your charting service allows. Go back on the S&P, and also do the Dow, but the Dow just prior to 2000, because now we don't look at the Dow, but the Dow prior to 2000 was a big deal. And what you want to look at are times where you had a recent high, like a 52-week high, like we had there, the 18,671, and then you quickly came down and touched your 200-day. So if you're at a high, you're going to be above your 21, you're above your 50, above your 200, obviously. So if you quickly come down, and quickly is subjective, I didn't want to put a number on it, but let's go unzoom this so we can see the 3 waves down.
Sure. Yeah.
You would want to make sure that you capture that one as well, where you were at 14,446 on down. And it did take several months to get there, but it was relatively quick from new highs down to your 200-day. Doesn't happen all that often. So what I would do is I would look at all of them, and then I would categorize their rebounds. Ones that turn into bear markets, ones that rebound, go straight up to new highs, and the other ones that kind of do like that 3 waves down. Put those in different piles. I would snapshot these. If you're using market surge, I would just take snapshots of them, maybe put them in a folder on your computer, and go back and look at them or print them out, whatever you're comfortable with. And then you want to study from that bottom, when it hit the bottom up to when it recovers up to new highs. How did it do it? What signals were there? Look at follow through days, look at the 21-day, but also keep an open mind. This is how you do original research. Just forget everything and just say, what Bill O'Neill would teach us is just, if you want to learn about fish, just sit in front of a fish tank. Don't read books, just observe it. That's what you're doing with this homework assignment. Just look at how they recover, make notes, and then test them out. That's what Bill and I would do all the time. We would say, oh, well, and back in whatever year it did this, let's test that out on other cases. And then you see, okay, most of your ideas are not going to work. Don't get discouraged. But that's how you stumble on things. That's how I stumbled on the 21-day, on a lot of things. And that's how Bill did too. You just do original research. So again, look at times where the market was at a new high, quickly came down, touched your 200-day, and then put them in different categories. Ones that hit the 200-day kept going lower. That was, a bear market. Study those. And then the ones that bounce, go straight up, or the grind sideways. And just, you want to look at, I would focus on the ones that snap right back first. If you're going to make this homework assignment a little bit more doable over a weekend, look at those, because that's what we're hoping for, and look for the signals. I will give you a hint. Look at the low above the 21-day. That is your clue. Also, so you understand how many follow-through days fail, go back to your peak. Once you would start looking for a follow-through day, note all of the follow-through days, and then when they fail, and pay attention to when they close underneath their follow-through day, how quickly they tend to unravel, like we saw last Thursday. So I know it's a big homework assignment, but you guys can do it.
Yeah. Okay. And we also want to wrap up with a new screen that you came up with, Webby. So here's a look if everyone wants to take a screen grab. Some of the same metrics that we've used in the past, but a couple of new things. So we've got current price above $10, price above 50-day and 200-day, so at or above the 200-day line. Then we have a liquidity requirement with 50-day average dollar volume of 25 million or greater.
And you can bump that one up to 75 if this list is too big for you. 75 million.
Good tip. And then price percent change on the day. We wanted something that's up today. We don't want any ETFs or closed-ended funds. And then this is the closing range, because since we had such a strong move for the indexes from the lows of this week to where we finished the week, we want to take a look at the weekly closing range above 75%. And then today, which was a setup day, what was showing strength today. So
yeah, and this should be your best. Yeah, this should be your best merchandise, right? Because it's at least doing what the market is doing. You could sort it by why am I here?
No,
I could be at the gym, by the way.
No, I'm not a mind reader, but I just have worked with you long enough to.
You're a Webby reader.
Pick up on some things.
Yeah,
so I'm sorting by for those listening to this who can't see what I did. Webby wanted to sort it by composite rating, and so did I. So
yeah, so this is where you would look for things. Now, some of them aren't going to be in position. Like, let's go down to that clear source,
sure.
which is the U, which
clear, yeah.
Clear
secure.
That came. Let's go to the weekly on that one.
Yep, I was going to do that.
Had a powerful move up this week. Obviously, you're not buying it up here,
right?
But this is something that then you want to go ahead and put on your watch list to make sure that if it does set up, it goes 3 weeks tight or settles down, builds a shelf or something, that you've got it ready to be bought. Because obviously with a week like this, and if it's up, 33%, something is going on. The HWM that we talked about, that's more quality type of name.
For sure. Yep.
Yeah. So there's going to be a lot of good things. This is, you can always tighten up the screens a little bit. If you're going to tighten it up, I would tighten it with the price, maybe put the price up to $20, put the liquidity up to $75 million volume, even $100 million volume. You could put a composite rating, above 70, but there's some times where there's some lower composite ratings in there that look good. Oh, there's the Cava that we talked
about. Yep.
Yeah. So lots of good ones in there.
Yeah. Happy screening, everyone. That is it for today. And we hope you all have a great weekend, and we will see you back here next week. Of course, starting with IBD Live Monday morning. Join Webby and I and our colleagues before the opening bell Monday, investors.com/IBD Live for all the details. We'll see you there. And then we'll also see you back here Monday, Tuesday, Wednesday, Thursday, and Friday after the close for Stock Market Today. Every day of the week we are here. And then we have you join us on Fridays, which we are glad to have you. So hope you have a great week, everyone. We'll see you back here next week.